You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that theme music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-exciting Options Insider Radio Network. Quite a few programs to choose from on said network, including well over 100 hours of archived Volatility Views goodness. Where can you find all of that goodness? Well, a legion of places, including the flagship, the mothership, theoptionsinsider.com. Surf on over, click on the Insider Radio Network tab. The overlay will pop up, and you're off to the races. Click on Volatility Views or whatever program strikes your fancy. You'll get full access to the archives to download or stream or whatever you want to do with them. Of course, you can also find us in all the big podcast provider stores, iTunes, Stitcher, Aha Mobile, TuneIn, you name it, we're there. And of course, if that's too much work, you can't be bothered, you just want to have it on your phone wherever you go, then grab our mobile app, available for iOS, Android, and the Fire OS, and it's all in there. You can make your own playlists, do whatever you want, stream, download till your heart's content. No shortage of ways for you guys to get access to the Volatility Views program as well as to the entire network. And joining me here on the old Volatility Views program, my usual volatility compatriot, the yin to my yang, Mr. Mark Sebastian from OptionPit.com. Mr. Greasy Meatball, welcome back to the Volatility Views program, sir.
Hey, thanks. You know, my nails grew 10 inches waiting for you to introduce me here. That was quite the Option Insider intro that you just pitched there.
You got to butter the bread, sir.
If people don't know that they can get the Options Insider at Aha Mobile, they're going to be crushed.
You know, a lot of people don't know about Aha Mobile till they get it in their cars and they realize, wow, what a great experience this is for mobile. At least until the Android and Apple CarPlay stuff takes off. So it's kind of a bit of a stopgap measure there. But soon will be available in every mobile going forward. And speaking of going forward, it's time for us to move on with the show right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. If you're just joining us for the first time, first off, welcome. Second, this is, of course, the portion of the program where we break down the week that was from a volatility trading and analysis perspective. A few interesting things actually happening this week. We, of course, had some interesting flow in some of the vol products going into, of course, the big bankers meeting this week. Then, of course, we also had some issues with the VIX settlement, as there always seems to be every month. So a lot to really sink our teeth into, and not a bad little range on the old VIX Cash as well, from about 12.5 or so, unless we've dipped back below that right now. Actually, no, we haven't. We're recording this, of course, listeners, on Friday, March 20th, for all of you playing the home game. Most of the major indices rallying pretty hard today, up over 1%, and the VIX Cash coming off on the downside, off about 1.25 points or so, hovering right around 12.8 or so right now. So we'll see if that continues throughout the rest of the episode. But Mark, a lot to really parse, a lot to sink our teeth into this week. So let's start with you. What really caught your eye this week from a volatility perspective?
Well, it was hilarious. I actually made a joke on Twitter, when everybody was all up, the zero hedges of the world were crying conspiracy because there were some quoting issues with the SPX.
Wait, zero hedge claimed a conspiracy? No, you're a madman. I refuse to believe it, sir.
So, I know you'll never believe this, but so there were some quoting issues on Wednesday morning, and we saw that the SPX was having some problems quoting, and it was messing around with the VIX reading, and the VIX was, reading in the 13s, and, zero hedge was out there just crying conspiracy and that the fix was in and that everything was all screwed up. And, anybody who knows anything was like, oh no, it's just a little quoting issue. It's not going to have anything to do with the actual VIX settle. And so what I told people was ignore the 13 you're seeing now, but you'll see it again on Friday, and that one you can believe. And here we are, and the VIX is actually into the 12s, which is even harder than I was expecting. But, you could see the writing on the wall. There was a lot of people that were kind of buying volatility into this Fed meeting. And since then, it has just been a complete vol sale. We've seen that front month future go from about 1780 was about the high on Wednesday morning. And it's now into the 15s. So just a really strong move in the VIX futures lower. And, in unsurprising fashion. Now, here we are, 12.8. If you add the weekend back in, it's maybe more like 13.5%. That's about where I think we're going to be for the month of April. April is traditionally one of the least volatile months of the year. A lot of people think like December. I believe, don't quote me on this, I believe April has the lowest average VIX out of any month that is recorded. And I think we're going to see more of the same this month. So that's where I think things are going.
Yeah, it's interesting you mentioned, the inflow into the volatility products, because a lot of the broad financial outlets were covering that going into the meeting this week, looking at flows into things. I think Barron's was talking about the flows into a lot of the VIX proxies out there, like the TVIX and the VIXY, of course, products that actually look at VIX going up or a VIX movement. They doubled, their inflows doubled over the past 5 weeks. Some of the shorter end, like XIV, their flow fell by about half going into this week, of course. So people not exactly perhaps looking at some of the short stuff like they usually do, and typically piling into things we've maligned many times here on this program, like TVIX. Hard to believe TVIX is still kicking, but that's a concept for another episode. I think Bloomberg also had an interesting piece looking at the impact of Fed announcements and Fed rate changes on volatility going into and coming out of. And of course, this week there was no Fed announcement. It was just more of a kind of yet another indicator. But people seem to really be loading their gun up in case something crazy was indeed going to happen. But it sounds like, Mark, overall, you weren't one of those out there wearing the tinfoil hat, really up in arms about the settlement this month. No,
and in fact, I think Jared's case for June, it's a good thing he didn't actually double down on his bet, because he'd be out some money or out some stakes, because based on what they said and how they were reading things, it does not look like we're going to get a rate increase in June. In fact, they basically ruled that out. And now the Fed funds are basically betting in October, believe it or not. So, that's just something to be aware of.
Yeah, he was pretty hardcore on that double down a few weeks ago. I should have taken him up on it. I kind of didn't want to. I didn't want to really let him hang himself that much, because it seemed a bit aggressive for him.
Yeah, I just don't think June's going to happen. Now he's saying September. We will see. could late 2015 happen if the economy really grows? But the big thing everyone noticed was the Fed downgraded all their economic forecasts, and that's why we rallied. I mean, I hate markets where we're counterintuitive, where bad news is, we're back into the TINA yield trade. There is no alternative but equities for yield.
Speaking of things that were maybe a little bit disappointing, we talked a lot, and people have made a big issue in the past about, of course, the triple and quadruple witching. We have one of those rare quarterly quadruple witching events coming up today, and people have done some research into what the impact of that. Of course, some interesting increase in stock flows going to these events because people have to resettle all of these various products. Of course, talking about index futures, talking about index options, single stock futures, and indeed the equity options we all hold so dear, all expiring on the same day. A relatively rare event, all things considered. But from a vol perspective, certainly not really contributing. Looking at today's numbers, of course, that bears witness to that vol coming off yet again today. And of course, I think the folks over there at Wall Street Journal did some interesting analysis of this, and they say that the VIX pretty much rose just in 4 of the last 12 quadruple witching sessions. So indeed, not really a big driver of volatility, which I think follows suit with a lot of the things we've been seeing in the general marketplace, Mark. I mean, we have expiration is no longer this mystical thing that occurs once a month. It's pretty much every week for the lion's share of products out there. So if they're going to be something that drives vol, I don't think quadruple witching is really on the front burner of everyone's mind. Do you concur with that, sir?
Yeah, it's not a huge deal. It really isn't. I mean, the futures stuff is, you'll see some stuff maybe over in the futures options, and if the whole crowd has a huge role to deal with, that can create some problems. But that's about it. You'll see kind of some interest rate moves on the futures rolls. A lot, that stuff will get thrown around in quadruple witching a lot more than you'll see volatility. There's just not a lot of reason for volatility unless somebody's kind of stuck in a position. That'd be about the only way.
And looking over to VIX products, people were actually trading. There wasn't a heck of a lot. It was actually Wednesday, of course, we saw some big volume in the VIX, not surprisingly. I think about 600,000 contracts and some change. The rest of the week, relatively slight. And there we're unlike last week when we saw that crazy ton of, I believe it was the April 50s going up that really caught our eye. By the way, those are still open, Mark, in case you were wondering. They haven't come in and closed that feverishly optimistic bet they made last week yet. So someone's still long a boatload, a technical term, of the April 50s out there. We also saw some more love on the nearer term, a little bit more, perhaps, shall we say, rational April upside, in particular the April 22s and 26s seeming to get the lion's share of the love, including some bucks like 5,000 lots going up today, people gobbling up the April 26s, the April 22s, and another 5,000 lot of the April 23s as well. So a lot of buy and love up there in the April time frame. Kind of interesting, maybe perhaps a bit of a counterpoint to what you were saying earlier, Mark, about expecting April to be a bit of a tranquil month. At least so far in the early parts of the March into April cycle here, it looks like the paper is kind of going the other way. Paper's saying April is going to be the new Rocktober. Do you concur with that, sir?
Yeah, I just don't see it. Where's the catalyst? I mean, I did see another trade that kind of caught my eye was there was a big out of the money put buyer in Morgan Stanley, and I was wondering if people are engaging in some, like, they're going to start watching a lot of the job and labor statistics a lot even closer, if that's possible. And maybe that's going to be a good news is bad news play. But I just simply do not see what would be a huge catalyst for volatility, which then again, because I don't see a catalyst, that actually, if something happens, that could be a catalyst for volatility. But you might just have people saying, the April future for $15, the April future, I'll buy it. And maybe there's some people out there that are watching the dollar or something like that that think something can happen there.
Yeah, not a lot else really playing out there in VIX options land, of course, after these weeks, post settlement, the open interest drops off a cliff. We're down about 3.65 million contracts. No point running through the top 10 because there's not really any big paper. The number one contract has about 137,000 contracts open. So not exactly big stuff, scintillating stuff. I will point you to this, Mark. I thought it was kind of interesting. It caught my eye this week as well. The folks over at the SIBO throw out a lot of interesting infographics and charts and data on their different products, of course, on a regular basis. They threw an interesting one up in the spirit of March Madness. I'm not sure if you had a chance to see it, but it was essentially their brackets for their volatility indices in terms of which ones had the biggest 1 week percentage moves from March 2011 through March 2015, this year, obviously, so the past 4 years. And before I give you the answer, what would be your guess as to which of their myriad, we're talking, of course, all of them, so RVX, VXTYN, GVZ, VXST, VIX itself, OVX, which of all of those do you think had the biggest?
In the last 4 years?
In the last 4 years.
Does that encapsulate August 2011 then?
I would, because it started in March 2011, yes.
Okay, so I would guess VXST. That'd be my bet.
Yeah, pretty safe bet there, and it is indeed the winner, the champion, with a 122.6% 1 week move coming in. I believe number 2 here looks like VIX EWZ with about a 57.4%. I thought it was a kind of an interesting way to frame it in the brackets. If you want to check that out, head on over to cboe.com for yourself. And speaking of seeing things for ourselves, or perhaps hearing things for ourselves, we are joined better late than never by the major domo of derivatives over there at BGC Partners, Mr. Jared Woodard. Jared, welcome back to the program, sir.
Thanks. I'm really glad to be with you guys. Sorry I'm late.
Fashionably late, as always.
It's okay. It's okay. It's about the only thing Jared does fashionably, actually, is show up late.
Well, he is a philosophy major.
That's not true at all. All right.
He was a philosophy major, so they're known for their tweed jackets with the elbow patches.
Yeah, I have amazing elbow pads.
All right, let's kick things off, Jared, with your week that was, from a volatility perspective, what really caught your eye? A lot to really chew on this week.
Yeah, one thing that surprised me maybe the most was the extent to which premiums sold off in VIX options this week. You know, it's been trending lower as markets have calmed down, but we hit, I wrote about this yesterday, we hit levels that were in like the bottom quartile or so in VIX option premium for the last, compared to the last 6 months. And so investors seem to really take some of the juice out of VIX options. In some cases, you know, at the sector level and single stock level, there were some real underperformers in the latter part of this week. So I think there's still some churn happening and people repositioning, and if anything, you know, might consider being a buyer of VIX premium at these levels. But you know, plenty to talk about as well in terms of bigger picture stuff, what the Fed did, what the economic data looks like for the near term. All in all, I think this was a week with a little bit more noise than signal, but still some pretty interesting developments. Well, you know, the other fascinating thing this week was the move in currencies. You know, there's lots have been written about this already, but that the end of the session on Wednesday after the Fed meeting, you had this what by all accounts was kind of running of the stops and people with dollar trades on. And what was just as fascinating to me was the fact that, you know, if you look at something like the euro and against the dollar or even the dollar yen, like they reversed a lot of the move by the morning, by the open the following morning. So really, really major volatility in the currencies that turned out to be kind of short-lived.
Yeah, well, what I was going to say is, you know, what I think we saw, and this was what really fascinating, is when you get a big piece of a big group of people that actually have an assumption on that rates are going up in June, and then that kind of really, probably to their shock, the Fed comes out and basically kills that idea. There is a lot of repositioning that needs to take place over in a very short period of time. We saw currencies move, interest rates move, we saw VIX move. You name it. And what it causes is also a lot of overreaction. And so I think this week, and it'll probably be kind of dissipated and solved by early next week. But I think we saw a lot of things get mispriced and overreact, and some real opportunity show up on Thursday and Friday. To your point, VIX premiums probably are a little oversold at this point, and maybe do look favorable, which is not something I say often.
Right? Yeah, me neither. I mean, I wonder about the reaction function on this. I think there's just a lot of the mix is really, I think, getting muddier and muddier here between how much of a given move we can attribute to positioning and the amount of leverage that people have on versus changes in their actual outlook. I mean, there's this distinction that Yellen's been making that I think is really insightful between talking about inflation and the market price of inflation risk, and she makes this distinction between inflation compensation and inflation expectations, and it's probably a little bit far afield for the show, but it's actually, I think, really analogous to what equity traders are familiar with. You've got forward-looking estimates of earnings as reflected in stock prices, and you have forward-looking estimates of risk as reflected in option prices. A lot of investors and even market watchers, even Mario Draghi for that matter, have kind of collapsed the two when it comes to thinking about inflation. Yellen's been working really hard to keep those measures distinct, and I'm honestly not sure that message has really gotten through to the market yet. People still looking, citing forward break-evens as evidence of very, very low inflation expectations, when in fact, Yellen's argument is that the survey-based measures and the price, even from options markets, caps and floors, all suggest inflation expectations that have remained kind of anchored, and so less reason to be worried about the outlook, more reason to take the Fed at their word. And I think that, if anything, the one thing I'd take away from the meeting was that they've promised to be data dependent. They came through with, the end of forward guidance, the removal of patient, and now they are data dependent, just like they said they'd be. And so in that respect, I think the meeting was ultimately a little bit less significant than traders may have thought.
Are you still holding by your double down for June? I'll let you out of that one if you want, because that was kind of a bit of a heat of the moment kind of thing.
I still think June's, more likely than the market's pricing in. I think it's, at this point, am I equal weight between June and September? I still think June's actually more likely. I think that we're going to get evidence of wage growth in late April, employment cost data. That combined with strong non-farms, and I think once you start to see March and April data where weather isn't a big driver, I would not be shocked to see upside surprises in terms of growth estimates, forcing the Fed's hand a little bit. This is kind of just a part of the game. Ultimately, I think what matters the most is the path over the next 12 months, rather than the timing of the very first move. It is just a quarter-point increase. In the grand scheme of things, not a big deal. But yeah, I think September or June are still my kind of base assumptions.
Speaking of the Fed and its impact on volatility and options, Bloomberg had a little write-up about looking at 3 months out, which is considered one of the more likely time frames that there is going to be a raise, and looking at the options for S&P options. I'm not sure if they did SPY or SPX, either one, 10% out of the money in the next 3 months, near the time of a potential Fed increase. They're saying by some measures, they're calling them almost 7 times more expensive than at the start of the year. I'll have to look and see what actual measures they're looking at. But what it caught my eye is they quoted some guy I'm not really that familiar with, Jared Woodyard, I believe. Jared, you might know this guy. And he says there's not much concern about the kind of risk that would drive you into very short-term hedges. The kind of risk that people are looking are in terms of profit margins for next quarter and the Fed move. This guy, I don't know, sounds kind of like a clown. What's your take on this guy, Jared?
Genius, pure genius.
The man knows his stuff. That's what you're doing when you're not on our show. That's why you're late. You're slumming it with Bloomberg.
Well, I try to provide insight wherever there are willing listeners.
I'm hurt, sir. You've hurt me to the core. You cut me to the quick. Speaking of someone beating you to the punch there, Jared, some folks out there over the past week may have beat you to the earnings study punch. Not so much what we were talking about with an earnings straddle going into, or straddle volatility going into earnings, but something analogous. It was kind of one of these iterations on studies we've seen before of unusual activity and options and how they perform, and talking about looking at overall. They analyzed, it was done by the folks at Options Metrics and a few other people out of Notre Dame, I believe, and Syracuse, and I believe one other person, I think, of University of Ohio Business School, all kind of contributed to this study. They analyzed a bunch of different things, including the raw option to stock trading volume ratio, indicating, of course, that options traders were more active than equity market participants. These are around news events, both anticipated and unexpected, the latter part being the more interesting. And what kind of surprised me about this study is they made some extrapolations, which I thought were maybe interesting, maybe a little bit unwarranted by the data, maybe not, depending on your opinion. They said that the researchers found this pattern, talking about, of course, what we talked about many times on this show, going into earnings, the implied vol gets increased, then, of course, it implodes like a balloon right after the earnings event. They said this pattern reduces the profitability of trading strategies involving long options positions and increases the profitability of strategies using short positions relative to when unexpected news events occur. So they say, all things being held equal, if this pattern holds fast of increase of vol, then a sharp decrease, surprise, surprise, short options are going to win, which didn't really surprise me. Then, of course, in the next paragraph, they go on to recommend if you think the stock's going to rally going into an unexpected event or earnings, you should buy a call, better off than shorting a put, which I found interesting because they had just extolled the virtues of selling premium. But still, Jared, do you have a chance to catch this study, and what's your take? I think someone is maybe encroaching on your territory a little bit.
Well, yeah, I haven't. I'm not familiar with this. Hopefully, you can post a link in the show notes on the website, or I'm not familiar, but it sounds like from what you've described, they may be looking more at the significance of options volume for moves in the stock rather than strategies actually involving the use of options. Is that fair?
Yes. They're looking at more, as it comes into and out of these particular news events. They weren't specifically citing earnings, but you think you can extrapolate what they were talking about, because earnings are probably some of the bigger anticipated news events out there that you can cite on a regular basis. Kind of interesting. I think for most listeners of this show, most of that data would probably become as kind of a no-brainer for them for the most part, because we talked many times about how implied volatility typically performs. Of course, they don't mention what we've said on the show many times, the outliers. You probably will do well 80-odd% of the time going into earnings being short premium. The other 10, 15, 20% of the time, you'll get your tail blown off. And so they don't really mention that portion in their study. But still interesting stuff. I thought it was interesting for you to maybe sink your teeth into, at least light a little bit of a fire under you, Jared, so we can finally get that straddle study we've been talking about for so long.
Yeah.
Someone else encroaching on your territory.
I do like this. There's these class of studies that have come out over the last 10 years or so where researchers will take information from options markets and draw conclusions that are applicable even to just Delta One investors, it's just long short traders, which is, I think, actually an interesting thing to do because of the universe of investors, still only a small subset actually trade options. So I think that one way that and we do this on the show sometimes too, is interpreting and understanding what options markets have to say for people who might execute in the underlying. I think that's a really kind of fruitful area of research.
And of course, I know you like to keep your eyes glued beyond our shores, Jared, and Mark as well. And there was a little bit of stuff going on this week. Of course, last week on the show, we were hinting at this kind of big Russian mystery announcement. Kind of turned out to be a bit of a not really much of anything, but at the time it seemed kind of interesting. And of course, we also saw the Israeli elections last week. So a lot of international things to consider on the volatility front. What really caught your eye last week from an international vol perspective, Jared, and indeed Mark?
I'll just say that I think that the change in sentiment toward Europe this year has been fascinating. I mean, you continue to have people doing things like, trading, it's like selling vol on Euro stocks and trading around those positions in a much more aggressive way and more sort of short vol, kind of a biased way than anyone, I think, expected this year. A lot of that's due down to the improvements in fundamentals and performance in these companies, but the success of QE in Europe, so to speak, combined with real improvement in the economic data, has led to some activity, I think, on the short vol side that's been pretty sizable, pretty interesting. The other thing that I think that bears watching is Japan. They've had this 2% inflation target. I think it was like 2% in 2 years was the real target. and they failed to meet that despite quite a lot of effort. And so I think that's something to look at going forward, whether investors and traders especially have the kind of appetite for an experimental policy that seems like it's kind of started to run out of steam. And I think the big question is whether Abenomics has another thing to do, another leg to go. Another thing to look at, I think, for the near future is Japan. They've had a 2% inflation target, 2% in 2 years approach that they've really failed to satisfy. And after a really great start, I think investors may be starting to tire and to start to doubt whether there's enough commitment there to achieve that target. So I think that might be a source of more volatility in the near term, especially if it looks like there isn't another leg or another part to Abenomics, and we just get kind of more stagnant and quiet periods from the government. So that's something I'm keeping an eye on.
Speaking of things we're keeping an eye on, I think everyone out there is still continuing to watch. It hasn't really flagged ever since the beginning of the year and towards the end of last year. Of course, crude, the song and dance with crude just continues. It's up, it's down. Things are bearish out in crude land. I know things are bullish. As of yesterday, of course, yesterday's session, we saw the bears come back out again in force after a day of rally. And now Thursday, Brent was down about 3%, WTI down about 2%. The dollar rebounding, kind of weighing a bit on crude. We're also getting into that time of year, Jared, when the refiners are starting to retool, getting ready for the big summer driving season. So they have to get all those blends ready, all those summertime blends, and it's a big time. Usually also it's a bit of a seasonal time when we see prices start to bottom. So some people out there are starting to say, hey, people are still taking oil on the chin, but if you believe in some of the contango we're seeing out there in some of these futures term structures, maybe perhaps this is going to be bottom city around this territory, because it doesn't seem like there's much impetus to pull it much lower, whereas we have some things on the near horizon that may indeed conspire to pull it higher. What's your take on what we saw over this past week, Mr. Jared, from a crude vol perspective?
I've heard two interesting takes on crude for the near term. A surprising number of traders talking about trying to make a case for another leg lower in crude, which seems kind of implausible to me, but people have been positioning in some cases for that. And then at the same time, some of the smartest traders that I know who trade commodity options have been doing some interesting things with sort of short gamma in the near term, long vega in the back in case there's a surprise, which I think is probably a little bit more in line with a consensus view in terms of direction, but takes more advantage of things happening in the options market to express it. And there's always the little stories you hear about as well. Obviously, anything happening in Russia can affect energy markets globally. And then questions about progress with Iran and what that would do to supply potentially. So there's those things are always a little bit present, but I think given the news cycle over the last several weeks, especially Iran, maybe more on the minds of people.
Yeah, you're right. I've heard some people, you're also kind of talking up the bearish case for crude, and it's kind of hard to get on that train where I think some people are really saying, if they don't break $40 some odd this week and the $40 level on some of these products, then it's probably not going to happen anytime again soon. So we'll see. We have a few hours left in the session today. I don't think it's going to happen today. So yeah, I'm kind of with you on that one. I don't really see a lot of impetus in the near term to drive it that much lower versus historically, at least, we've seen some impetus to drive it higher. And again, if you believe in that contango out there, then we should be headed higher sometime in the near future.
You know what else, Mark, is I saw some really interesting data. We put up a chart about this actually on early in the week, but in Texas they collect data on the motor fuel taxes that the state collects, and the government publishes those. And so it's one of the highest frequency economic indicators we have, I think, of real-time demand for gasoline. And this is important. I think that the punchline to that was that the year-over-year growth, seasonally adjusted, in motor fuel tax revenue for the state of Texas, including, I think, up to February, at least January for sure, was at some of the highest year-over-year growth rates that are on record. I mean, just incredibly massive demand, as evidenced by these tax revenues, which is really interesting to me because that's obviously a part of the country that hasn't been affected by intense winter weather. So if that's any kind of bellwether for what's likely to happen in the rest of the country once driving season starts and once the weather warms up, it may just be that this much talked about boost to consumers from low energy prices. I mean, my take is that this is something we haven't seen evidence of yet because the idiosyncrasies of the weather have kind of prevented the realization of a lot of that. It also has a longer lag. But if that Texas data is any kind of sign, we could see a really major surprise to the upside in terms of fuel demand in the next month or two.
Interesting stuff. All these little nuggets of data coming out to kind of make the collective story on crude. I guess we'll only have to wait and see, but it's amazing. I think we really could do at this point, maybe we should have done already, a entire crude volatility program, because you probably could fill an hour with the various vagaries of the crude futures term structure, what's going on out there from a vol perspective, from an underlying perspective. There's certainly a lot to digest. And certainly we have devoted increasing amounts of time to it on this program, and I don't think it's going to be, at least when you're looking at gauging the amount of time crude takes on this show as any sort of indicator, that's not decreasing anytime in the near future. And I would certainly bet on that, going perhaps up, if anything. All right, speaking of time, that's going to do it for our volatility review segment. We want to make sure you guys get a chance to join us on the old program today as well, so we're going to dive right on into our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. This is indeed the portion of the program where you guys get to join us, make your questions or comments known to us. Got some good ones coming in here. Jerry, we're going to start off. I like this handle from the great Donaldo. I think he gets points just for the handle alone, Jared. And he writes, "Hello to the Volatility Wizards. I enjoyed your coverage of the RMC conference and Mark's interviews with some of the speakers. I've never been able to attend the event due to scheduling conflicts. I'm also not partial to attending an event that is primarily intended to promote one firm's product. So I'd appreciate your informed opinions on other volatility-oriented events that you feel are worthwhile for the listening audience to attend. I don't mind some forays into the mathematical realm, but I'm not interested in modeling so much as strategy and theory. Thank you for all of the work that you do to shine light into the darkness." Well, there we go, Jared. I guess we're shining light into the darkness these days.
How poetic.
I know. they're definitely, our listeners are nothing if not literate in their questions. So I like that. Great question, great Donaldo. Great handle as well. I love that. Like I said, you get bonus points for that. And this actually is a good question because we talk a lot about RMC. It is a good conference. Brings up a lot of good volatility general stuff. It's one of the big mainstream events, but also, of course, it is put on by the SIBO. So there is going to be some, flavor of their products scattered throughout. It's just kind of the nature of the beast with events like that. And he brings up an interesting question. I was trying to think when I saw this question come in. It seems like these types of events that he's referring to, the volatility-themed panels and sessions, they were all the rage kind of, I would say, a few years back, maybe the 2010, 09, maybe 2011 range, when VIX was really starting to begin its ascent into the mainstream retail mindset. It seems like every time I was looking at any sort of private, institutionally oriented event, they were all some sort of volatility symposium or some sort of volatility this or volatility that. It really was the hot thing in the private conference sector. In recent years, that has kind of flagged somewhat. I haven't seen as many of those now. It seems to have been, a lot of these firms are out there chasing the latest thing. So we're seeing a lot more in the last year or so of HFT symposiums and other things that have kind of fintech related, other things that have kind of become top of mind for people, whereas VIX volatility kind of came off a little bit last year, at least in the broad mainstream perception. So there weren't as many, at least that I saw, of these types of events. I certainly didn't attend as many as I have in recent years. Or back in that time frame, I remember I was attending, it seemed like a couple of these, 2 or 3 or 4 of these types of events a year in New York and in Chicago and other places. And now it kind of seems like RMC is certainly one of the biggest of the bunch that's left standing. And clearly they're able to do that because they all also have other reasons to do that conference. It's not just trying to sell attendees tickets. But it seems like the people who are doing a lot of the private stuff seem to have moved on to other things. Jared, would you concur with that? There are probably fewer really good choices from a volatility-oriented event perspective than there were even a few years ago? Or do you think there are still some good nuggets out there for our listeners?
I think you're right. I think anecdotally, it seems like there have been fewer events that are put on by people or organizations that don't specialize in the options market or focus on it. But I think there are still also some events that other things that people can look at. There's there's a they call it a volatility summit that goes on every year. I think it's put on by a hedge fund in town. Although I think that's more a little bit more closed door for professionals, but there is an event coming up in the spring. I think it's in May, put on by a relatively new site called EQ Derivatives, and they're putting on an event in Las Vegas that might be of interest.
Those people are terrible, the EQ Derivatives folks. Peter Thompson and their ilk. I refuse to plug them on the show. No, they're good guys. I didn't know they were doing an event.
Yeah, they are, and I agree. They're good guys. I actually wrote for their site for a little bit. Got to put up some things there, and I think they do really good work.
I guess that shows where I stand with them. Not even an invite to the event. So there you go. Now they're on my naughty list.
And there are if you're a professional or in any way attached to the industry, there are a lot of events put on by other publications, individual broker dealers will have conferences with clients and other kind of things like that. In terms of individual investors, I guess there may be fewer events, and part of this I think might just be actually part of a secular trend in which the kinds of the reasons you would go to a conference in the past are fewer now. Namely, if you're like me, you'd rather read something that you can read in 30 minutes rather than sit and listen to it for 2 hours. And I think that technology has made these events a little bit more about networking and connecting with people rather than just sort of consuming information. So if you're interested in trading and strategy, the questioner mentioned less on modeling and more on strategy. And I think that the good news is there's quite a lot of resources and quite a few people out there who are doing really interesting and valuable work in derivatives research and strategy. At many of the big banks and other broker dealers have offerings in this area, and even there's some independent providers of that as well.
I think you're right, too, on the publication side. A lot of these are put on by private publications. A lot of those have fallen by the wayside in recent years. It's a difficult business to run a publishing business, as I know. So a lot of those have kind of fallen by the wayside. You're right. And I think, like I said, a lot of these other companies are chasing the hot thing, whatever that is. And these days it seems to be HFT and related type things, as well as Dodd-Frank and the regulatory side. So if you're a professional, you're being pulled in a lot of those directions and not as much going on. I'm a scintillating cutting edge fashion from a VIX volatility perspective. So I think that kind of has played into it as well. I'm trying to think of all the events I've attended and spoken at over the years, how many of those are actually still around. I can't remember any of the names of them, so that doesn't bode well. So I couldn't really recommend any of them off the top of my head to the great Donaldo here. I do recall, Jared, I had one of my earlier experiences with some of these when VIX was really coming up, and we were talking about, I remember we had a great session at one of these events, I believe it was in New York, and I was on a panel, we were talking about VIX, and I brought on Henry Schwartz from Trade Alert, who I'm sure you're familiar with, and we proceeded to go at length. This is in the early days of the settlement, where we're still very controversial, and kind of outlined how people with the options flow were really systematically trying to carpet bomb those out of the money puts. And it was one of the first really big, systematic approaches that I had seen, and certainly that I had been a part of, to really explain it to people and show how much volume was going into these types of trades and how much actual money was being committed to trying to, quote unquote, manipulate that, for lack of a better word. And it was very interesting, very well received. A lot of people enjoyed it. And then immediately after us was a session I believe put on by the SIBO, where they were touting the VIX and its many alternatives as a thing. I think Larry McMillan was on that one. So it was an interesting juxtaposition, us versus them. But it was kind of interesting to see that kind of stuff go forward. And it hasn't been as many of those in the private space as I've seen in recent years. So maybe the great Donaldo is onto something.
Mark, that's a really good story, actually. I mean, you could think of there may be a nearby possible world with an alternate history where the path followed by a massive rise in VIX trading and relative stagnation in individual equity options happened a little bit differently. And you could argue, I think, right now that with the decline in volume in VIX, that may just be a temporary blip, but that as correlations come down and equity fundamentals start to matter more and more, especially in the U.S., that this might be a situation in which the sort of big picture hedges and index trades fall out of fashion a little bit, and equity options become more important and see more volume, and we have a whole, maybe there'll be a conference where Henry and you can argue that same point 10 years later.
Yes, I think we could. It was an interesting conversation. So I think obviously the flows out there have mitigated somewhat since the very, very early days of that. It's not as valuable of a strategy as it once was, but still is interesting stuff to discuss, and to actually be some of the first people to put some hard data to it was certainly fun. We have one more question. I think we have time for one more here. This one comes from Lee Daniels. Kind of an interesting thought question here. He writes, what is the absolute baseline level of volatility that we could reasonably expect to see in the marketplace? I've heard you guys talk about a VIX in the low teens on earlier episodes. We have that right now. In the 12 handle right now, Lee. He goes on to write, is a single-digit VIX feasible? And if so, for how long? Could we ever see a VIX below 5? What sort of situation, would it take to achieve such historically low volatility levels in the marketplace? A very interesting question, Lee. And you're right, we have talked about VIX being on the low end of the spectrum. We talked a lot about that last year when everyone was beating the drum when VIX got into even higher than it is now. When VIX was getting into the 13 and 14 handle last year, people were saying it was already too low. We're well below those levels now as we stand here on the show today. VIX getting back over the 13 handle, but just barely as the show has progressed today. So we're still on the lower end of that range. But this even still, for anyone who's been doing this for a while, I know when I first got out in the SPX in, I believe, like 97 or so it was not a period of inflated volatility at all. We saw stuff in the low teens for quite some time, and right around that time frame, it had also been not that long before I got in the pit, it had been flirting with getting into the single digits. It had flirted with that very briefly a few times. So we have seen that single-digit VIX. If you look back at any historical chart, you can go find this data yourself, Lee, on SIBO or any other place. You can find VIX historical data, and you can see this for yourself. It has flirted with that level. It never really stayed there for very long because I think there is some argument to be made that there is some structural level of volatility in the marketplace. I don't know. That's kind of what he's asking here, Jared. Where do you think that is? I think looking at the data, it's kind of hard to argue that it isn't. It's much lower than 10 because it hasn't really stayed much lower than 10 for very long. So maybe that structural level is somewhere around an 8%, maybe 9%. Where do you fall on that kind of like structural systemic unemployment? What's our systemic VIX?
Yeah, I mean, I think you're right that the approach to take is to put yourself in the shoes of a market maker or somebody who has to take the other side of the sort of natural pressure that might be happening on a given day, and where how low would you sell? Let's just keep it simple. How low would you sell S&P at the money vol? And it's fun. We can imagine a scenario where stocks just don't move for an extended period of time, and realized vol gets down into the 5 or the 6% range. But even in that situation, I think in the past we've seen VIX stay around 9 or 10. So it's really hard to imagine a situation in which someone would be willing to accept much less compensation than that for being short volatility. And the thing to remember too is that when you're talking about the VIX calculation, even if at the money vol gets especially low, the fact that the fact that out of the money puts have the weight that they do in the index means that you're still going to have some skew priced in that would, I think, keep VIX a little bit higher. So yeah, it's hard to imagine any persistent prints below, say, 8 or 9 for any length of time.
Yeah, I would have to fall somewhere in that range because I certainly would not be comfortable selling it. And I've seen it get flirt with those levels and then, pretty much systemically rebound eventually. Something is always going to happen in the broad market or something to eventually bring us over that. He also asked an interesting question. What would it take to keep us down below a 5? My God, it would have to be just the most tranquil horizon you could ever think of from a market perspective. Global peace, of course, no impending hiccups from the Fed, monetary policy, just straight and narrow for the foreseeable future. No impending hiccups anywhere that you could really foresee. Just a total tranquil period in the marketplace and foreseen for at least the next 6 months. I think that could get us to a 5 sometime soon, sure. I don't know,
but this reminds me of something. Citigroup put out a note a week or two ago. They did a survey of clients and asked, can you ever imagine a situation in which credit default swaps would be priced negatively? In other words, the cost to sort of offer protection against default by some credit issuer would actually not be a cost, but would be net credit. And that's really counterintuitive. And I think most respondents said, well, absolutely not. Of course not. And then some folks came in with cases about how spreads might be such that you could see this trade negative for a while, that, the cost of capital for a bank might make it worthwhile for a very short term, and other kinds of very, very unusual structural or regulatory or capital requirement type reasons why that might be plausible. It got me thinking about what the analogous case of could a S&P put option ever be priced at a negative premium? And I don't think we'll try to delve into that thought experiment today, but yeah, I think it's an easier answer. I think that the answer is no, and that in the case of VIX, it's no as well. And I can't imagine ever wanting to sell an S&P put for 5%. That just seems like even for a volatile. We should ask Don over at Volex, because if anyone would be willing to sell, maybe it would be him.
Yeah, that's a scenario where I think he would say not sell.
Okay.
That's his infamous not sell or not sell, and that would definitely, I think, fall into the not sell category. Well, we're running low on time here, listeners. We'll go to a really quick dive into the old crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, Mr. Jared, you're running low on time. Mark had to skip out, so you're the sole victim in the crystal ball for today. Really quick, what's your prognostication for the week to come from a volatility perspective, sir?
I think we see implied vol and VIX options go back up, like we said at the top of the show. I think that everyone who overreacted to the perceived dovishness of the Fed this week might feel a little bit more pressure. And I think that the euro will continue its medium-term trend in spite of the move we saw this week.
And so just to translate that for our listeners, you're saying you expect a move to a 5% VIX forthwith.
Precisely.
Exactly. All right. Good stuff, sir. And unfortunately, we'll have to leave it there. That's all the time we have for the crystal ball. It's also all the time we have for this episode of Volatility Views. But before we go, as always, Mr. Woodard, in between your cheating on us with Bloomberg, what else are you cooking up over there at BGC Partners?
I have been doing a lot of work lately. I think I mentioned this before, but doing a lot of work for particular clients on things that don't go out for distribution, but helping with trades and ideas and structuring and strategies. And I think there's a lot of potential there. And so folks who are interested in that can get in touch. And as well, looking at some screens for companies with lots of U.S. exposure, a little foreign exposure, and what options markets are saying about them for the near term, especially the next earnings cycle.
Well said, sir. And I'd be remiss if I didn't also remind you guys to surf on over to optionpit.com. Check out what Mark and Andrew have cooking over there. Some great webinars they're putting together for your edumacation in the realm of volatility. And on behalf of Mark and Jared, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the program, and for sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.